Chapter 10, Accounting for Treasury Stock. We just looked at the issuance of common and preferred stock. Now we're going to look at what happens when companies buy back shares of their own stock that they have previously issued. Treasury stock is when the company buys back their own stock, and they could do so for various reasons. To boost underpriced stock. When company management feels the market price of stock is too low, it may attempt to support the price by decreasing the supply in the marketplace. Supply and demand. You decrease the supply and the demand increases, which thus drives up the price per share. To distribute surplus cash without paying dividends. While dividends are usually a good thing, investors have to pay personal income taxes on them. Another way for a firm to distribute surplus cash to shareholders without giving them a taxable dividend income is to use excess cash to purchase back their own stock. Under a stock purchase, only shareholders selling back their stock to the company at a profit incur taxable income. To boost earnings per share. Earnings per share, which we'll discuss in depth at the end of the chapter, is calculated as earnings divided by the number of shares outstanding. Stock purchases reduce the number of shares outstanding, thereby increasing earnings per share. However, with less cash in the company, it's more difficult for companies to maintain the same level of earnings following a share purchase. So this is not a good option or good reason to necessarily buy back stock, because then you might have to continuously buy back stock to keep that earnings per share boosted to where it was the first time you did the buyback. To satisfy stock options, employee stock ownership plans. Another motivation for stock purchases is to acquire shares used in employee stock award and stock option compensation programs. So how do we account for treasury stock? Treasury stock is the purchase of a company's own issued stock. Just as issuing shares increasing stockholders' equity, buying back those shares decreases stock equity. So in this example, Canadian Falcon repurchases 100 shares of its own 1 penny par value common stock at $30 per share. Rather than reducing the stock accounts directly, however, we're going to record treasury stock as a separate negative or contra account. So treasury stock is a contra equity account, which means it has that normal balance side of a debit. By debiting treasury stock for the 100 shares times the $30, we're decreasing our equity account by $3,000. The other side of that is to credit cash, the amount we actually paid for those shares. Notice, the stock's par value has no effect on the entry to record the purchase of treasury stock. So we debit treasury stock to reduce stockholders' equity. Treasury stock is a contra equity account. So here's Canadian Falcon's partial balance sheet. We already looked at this column before in a previous video, so it was $100,000. Now we have purchased back treasury stock. There's no change in the preferred, no change in the common stock, and no change in the additional paid in capital accounts. These remain the same. Retained earnings is not touched. Instead, after retained earnings, we show a new account, this contra equity account, treasury stock for 100 shares. So it is shown as a negative, a decrease of $3,000 to bring our stockholders' equity down to $97,000. Let's discuss now the reissuance of treasury stock. So Canadian Falcon decides to resell the 100 shares of treasury stock for $35. Remember, these shares were originally purchased at $30 per share. So first thing we want to record is our cash. We sold 100 shares at $35 a piece. We're receiving $3,500. Next, we need to take the treasury stock off the books at what we paid for them. Treasury stock will then be credited for $3,000, the 100 shares times the $30 that we paid for them. The difference, the $500 difference, is not recorded as a $5 per share gain in the income statement because it's not an investment in another company. We're reselling our own stock. So we need to increase additional paid in capital. That's more money that people have given us as investment in the company than we originally paid for it. When we resell the shares, we must reduce treasury stock at the price we paid. The difference is additional paid in capital. If we had not resold all 100, then say we only resold 20, we would record the 20 at 35. Treasury stock would only be 20 shares at 30, and additional paid in capital would be 20 shares at $5. We don't have to reduce treasury stock down to 0 unless we sell all of our treasury stock. Now, in this example, we reissued treasury stock above what we paid for it. So this is what our balance sheet looks like now. Our additional paid in capital increased by the $500, and we have no treasury shares remaining. So our overall equity count is increased by $500 from what it was before we did any treasury transactions. And remember that $500 came from the 100 shares that we sold times $5, which is the $5 increase over what we paid for the treasury shares versus what we sold them for. What if we had issued treasury stock below what we paid for it? Assume now that they resell the 100 shares of treasury stock for only $25 and we had paid $30. How would that journal entry look? How much cash did we receive? Well, we sold 100 shares for $25. We would receive cash for $2,500. We need to take the treasury stock off at what we paid for it, the $3,000. 100 shares times the original cost of 30 is $3,000. This time, the $500 difference is a debit to additional paid in capital. Not a credit, a debit. If you reissue treasury stock below the cost you paid for it, then it is a decrease in additional paid in capital. It would be a debit of $500.